Let's start with the G fund. The G fund, G in this instance stands for government securities. G fund is specially issued short-term treasuries to the TSP. So what does that mean in English? Well, the G fund is, again, short-term treasuries. So these are government bonds that have short maturity dates, meaning less than 1 year. So it's government bonds that mature in less than 1 year. They're backed by the government, which makes them a little bit more, it reduces the credit risk of them. And they're specially issued to the TSP. What does that mean? It means that they're not traded on the open market. The TSP is not just buying these off of the market. They are specially issued from the government to the TSP. The big advantage of this is it creates less price volatility. When something's traded on the open market and there's buyers and sellers, it's constantly moving the price around as buyers and sellers try to agree on a price. Since the TSP is the only one that owns these, it's not buying and selling with itself constantly, and this reduces, again, the price volatility. So the G fund is a very good place to preserve cash when you need to. So if you're going to be using funds in a short time period, maybe within the next couple of years, the G fund is a good option because the G fund has never gone down in its history and it has much lower price volatility than what you might find in short-term treasuries on the market. Since its inception in 1987, the G fund has had an annualized return of 4.65%, which is great because it's slightly higher than inflation. So again, rather than keeping dollars under your mattress or in a checking account, this can be a really good option of protecting yourself from inflation, since it's grown more than inflation, without the risk of it going down, barring the government's collapse, basically.